might be a fraction early, but we'll begin the second session this afternoon, which is really a portfolio review and looking back at not just the past year, which is we've written a lot about in the annual report, but trying to understand the last few years, and in doing so, maybe talk about what might happen next and what sort of shape the portfolio is in. This is the massively legible risk warning, usual kind of things. Don't take anything we say as personal investment advice. We're going to be presenting some companies to you. I'll be talking about a lot of names. My intention of that isn't that you go out and buy or sell any of them. It's simply to educate you about what's in the portfolio, things you already own. Before I launch in, I should just say that on our website that you'll find some Q&As from the AGM. So we invited shareholders to send in questions beforehand, and we've had a number of questions that come in to Fiona, the chair, and we put answers up on the website, so feel free to go and look at those. So this is the journey that we've been on over the past 14 years now, and we choose this date because this is when Amati started, back in, actually 3 months before this, in 2010. But it's also the date at which, March 2010, is when we took over the management contract for Victory VCT, and Victory VCT became Amati VCT2, and when we merged everything together, this was the Survivor VCT. So this is when we took over the management of the VCT. Obviously, First State AIM VCT, which I started in 2005, and Peter Lawrence, who's here today, was on the board of when we started it. That merged in. But that's the reason we go back to March 2010. It was a significant date of taking over this particular contract. And you can see it's been a very difficult journey over the last couple of years. So a year ago, I was standing here saying, it's been a difficult year. Sadly, I'm coming back today to say it's been an even more difficult year, arguably in the past 12 months. And it's important when we go through these times in stock markets to kind of, we look back at history, we try and understand what's going on, we try to analyse the problems, and it's very important to understand the shape of where we're up to, because obviously the question is, well, does this carry on? Is this a moment when it's all, these kind of trends are just unstoppable, and therefore you should just sort of stand clear and sell, or actually, is the opposite true? Have valuations, when markets fall, obviously valuations tend to compress, and companies themselves respond in interesting ways when times get tough, and actually normally very productive ways. And it's quite interesting to consider actually what do companies do in response to very difficult market conditions. And actually, the kinds of things they do is they cut costs, they become more efficient, they focus their business plans, they try and really understand their core qualities, and in many ways, it can be a good catalyst for the business to progress. So this is the broad picture. It's worth just saying a little bit more about this, that period from 2010 up to 2021, actually, when the market peaks. But there were a few distortions in 2021, which I'll come back to. But broadly, this was a period when it was possible for digital technology to be commercialized very effectively by small businesses. And I'd say that was probably the big theme. I talked a lot about it over the past 14 years, the digital technology industrial revolution. And we did very well out of it, and VCTs were a beneficiary of it. It's never easy investing in very small early stage companies, but in many cases, there was this big theme to go for, and not in every case companies who invested, but in many cases, there was this theme of the successful deployment of that technology. And I think around 2020, I did start to raise this question: at what point does that particular industrial revolution run its course? And I was starting to notice that actually you didn't want to be a startup in 2020 trying to industrialize the digital technology revolution, because you're too late. And the pendulum started to swing back to larger companies defending their business model successfully and themselves deploying this technology. And then, of course, we had COVID in 2020, and the world went slightly mad for a couple of years, and all the kind of ground rules that we were used to sort of got disapplied for a period of time. And in particular, what happened in 2020 was the government printed a very large amount of money, and this had a number of effects. One of the effects was it wasn't just the UK government, it was Western governments in general, and especially the US. One of the effects, of course, was that inflation spiked to a crazy level, and a very, very uncomfortable level, which came as a rude reminder of what inflation does. And I found myself in 2020 and 2021 going back to articles written in the 70s, because I couldn't remember what do markets do when inflation spikes up. I mean, I had no sort of living memory of that as a condition, and I maybe naively thought that, well, actually, we're making real investments in businesses. They can put their prices up if there's inflation. Actually, you want to hold equities because these are, if you like, real as opposed to nominal value investments, and the companies themselves' profits should rise with inflation. Actually, that didn't turn out to be the right answer, as is now obvious. And what happens when inflation goes up is the discounting mechanism of the market becomes aggressively rewritten. And this word discounting is something that financial analysts do all the time. And we use a discount rate to discount what we call discounting future cash flows. So with a company's profits, you estimate them out into the future, and then you use a discount rate to turn them back into today's values, and that's the value of your business. And so if you're discounting at 0.5% interest rate plus your equity margin, it's a very different result from discounting at 5% plus your equity margin. And so the valuations of companies started to get heavily compressed. And it's of course we thought this was going to happen, but we underestimated exactly how aggressively and fast that was going to happen. I think I probably stood here saying, I hope I did anyway, that we were expecting inflation to rise, and I suppose I was pretty heavily influenced by some of the monetarist economists who were writing, just sort of shouting from the rooftops, inflation's about to take off because so much money's been printed. And very often in the public debates about this, they say, oh, well, politicians like to say there was nothing we could do about it. This was it was a central bank set of policies in Western markets that we overprinted money in response to the pandemic. And in the US, for example, there was something like a 20% increase in money supply, which is, for every dollar in existence, for every, $4 in existence, there was a new one printed. And so it was bound to be inflationary. And then, of course, when the pandemic finished, there were supply shortages, there was lots of cash around, and the problems were springing up all over the place. So there's far too much money chasing too little supply of goods, and that created very big distortions in the market. And one of the things I'm going to be talking about today is in 2021, this peak of the market, money was free, there was too much of it around, and I have to say the AIM market, we as fund managers, the broking community, collectively, people involved in the AIM market did a very bad job in 2021. And most of the investments we made that year were poor. They were overpriced. The companies weren't good enough. I did some analysis on this when we were going through the strategic review with the board, looking collectively at the VCT qualifying possible investments from 2021. The average investment was down by more than 70%. And so, this is not a number that we can live with. But, I think it was born out of a very hot market, a sort of freak set of conditions. But it's done a lot of damage. And so part of the story of why the past 2 years have been painful is, unfortunately, the 2021 vintage of investments, which was a significant vintage of investments, was just poor. One of the companies, and probably our most sort of sad story in a way, you'll remember seeing the presentation from Saeta here, which was a company we had enormous hopes about, a UK company developing a leading electric motor technology. It looked like an absolutely prime technology for the electrification of vehicles, certain sets of vehicles. Unfortunately, there were a few problems with it, one of which was the chief executive who came and presented very brilliantly here just got way too ambitious about the company and money was cheap, splurged far too much money, assumed he could carry on raising money from a market that then claimed shut. And quite a lot of the business ventures that he tried to pursue didn't work. Then the change management team, it was kind of then, from then on, a story of too little, too late. And actually, interestingly, it then turned out in the final analysis, and the thing that eventually sunk the company right at the end, was that the Indian OEM companies they were going to sell this technology to started running scared of Chinese competition. And as you know, the Chinese completely dominate the battery and electric vehicle supply chains and technology, apart from Tesla, which is a particular set of vehicles. But the Chinese have dominated the market in battery technology, in a whole host of associated technologies. And they can produce these things at just lower cost. And so then some of Sciata's customers, even though they contracted a certain amount of order, but they just started slowing down, didn't deliver what they were supposed to deliver in terms of orders, and the company just got into a place which was impossible. It was running out of money, the orders weren't arriving, the market was shut, and just very sadly, the company went under. So, you know, it was one of the very painful experiences of this period. So we'll talk a bit about 2021, and I think it's just important to be really upfront about it. I think it was a kind of collective, well, I don't want to use the word disaster, but it was a very poor period in the AIM market, and it's given very bad results for investors, that period. But, you know, that is one period in the portfolio's life. And I suppose what I'm going to go on to say is that, you know, that value from the 2021 investments, we've got a couple of survivors and they'll probably do well, but a lot of that value's been lost. We're not going to get that back. But it's only one little bit of the portfolio, and there's a bigger picture here, which we're going to go on to have a look at. So before I do that, I'm just going to set the context. The usual slide on dividends. As you'll know, we have a 5% dividend policy, and this is one of the sort of big features of the VCT. And in considering this investment, you know, just bear in mind that a lot of the value you get from it is in dividends, and we have the dividend policy, which we just voted on. The board took the decision, which we supported, to pay a special dividend this year. And I'll come on to talk about that next, about why we did that and why the cash built up in the portfolio and in a way wasn't going to go down to the right kind of level. So we wanted to return some surplus capital. But you know, this is a big feature, and when you analyse this investment, remember the dividends, they are a capital return. So don't view them as an income return. This is more a capital return. And it's a feature of every VCT pretty much in the market, which seems to have settled around a consensus of 5%. But we've been there, I think, for the last 14 years. This has been our policy. Oh, hang on, that wasn't the market or company I was expecting next. Okay, we'll go through these slides next. So I'm going to talk a little bit more about the AIM market in general, because there's been a lot of discussion really about, well, what's going wrong with the AIM market. There are some things that there are some big problems with it. And I want to set the context by looking at history, looking at some of the statistics to give you an idea about really where is the AIM market up to. So this is history going back to its beginning, 1995. Sorry, these slides may not be hugely visible, especially at the back of the room. So I'll just describe what's on the slide. The gold bars are the number of IPOs on AIM of UK incorporated companies, and the red slides show you number of IPOs on AIM of non-UK incorporated companies, so overseas incorporated companies. And as you can see, there was a big rush of unquoted companies in 2005-06. Actually, quite a number of those were Chinese companies. At that point, it felt like, it sounds surprising now when we say it, but at that point, it felt like China and the West was going to become more integrated. And this was way before the two things were drifting apart. It turned out, actually, most of the Chinese companies that floated on AIM were, in our terms, frauds, but in Chinese terms, it's a very different legal system, very different way of doing business. People who got involved in those Chinese IPOs, with one or two exceptions, had a pretty bad experience. But there's also a lot of US companies that float on AIM, and there's a lot of companies from Australia, natural resources companies, Canada, a lot of dual listings. It was a very international market, and that is an important part of its DNA in a way, and it wants to function as an international market. What you'll see in recent times is, you know, the huge issuance of 2004, 5, 6, 7, that's already died back. There's been a steady decline from about 2014 of number of IPOs, a brief spike in 2021, which was a very unproductive spike, and then much lower levels the last 3 years. And it's become really problematic how little replenishment there is of companies in the public market space. I'll just show you a few more statistics here. This is the amount of funds raised on AIM. Again, you can see 2005, 6, 7, huge. The gold bars here are secondary financing. So these are companies that they're listed, but they come back to the market to raise money. The IPOs are in red. And as you can see, fundraising over the last decade pretty much has been dominated by secondary market transactions. And primary market IPOs, it's been diminishing. And especially the last 3 years, almost nothing. Then average daily traded volume, a lot gets talked about liquidity on AIM. This picture is interesting. You can see 2021, when the market values were very high. Of course, the average daily traded values, you'd expect that to be up. In general, what's happened here is volumes have kind of been okay, but they've been lagging the market value. So I'd say they've probably dropped in proportion to market value by maybe about 10% over the course of this history here. And finally, this is just showing you the number of companies on AIM in the gold dots against the total market value. And where we stand now, we've got a total market value of, say, 80 billion, number of companies just over 600. And I suppose the thing to say about this is, yes, it's declined and it's been declining, but this is still a significant market. And there's still a lot of value on AIM. There's still a lot of companies on AIM. Some people are trying to write the obituary of the AIM market. That's completely the wrong thing to do. This is still one of the most dynamic small company markets in the world. It's just there are some trends which are negative, and this is where policy discussions need to be had. And actually, this applies to the London Stock Exchange. You need to think very hard about this. It applies to all the regulators who haven't paid enough attention to this. Some of what's causing the decline is just over-regulation. Every year, regulations become more and more complicated. In every set of rules I can think of in regulations, you have kind of rules going this way, rules cross-cutting that way. It's very confusing. It's incredibly complicated. It's a lawyer's and accountant's dream because you can't do any piece of business now without serious advice because of the complexity, and the advice is very expensive. So it's become the friction of doing business and the friction of listing has become, I'm afraid, become too high. And this is where a number of people who are in charge of these things really need to pay attention, and we need to see some simplification and some cost lowering. And then finally, in terms of statistics, this is talked about a lot. This is the ownership of UK listed shares. And this since 1989, and these are figures from the ONS. They only get published every 2 years. So this is by and large 2 years out of date. It goes up to 2022. And the big things to say here, this red line is pension fund ownership. That's talked about a lot. The decline of pension fund ownership of the UK market, it's dramatic. They now own almost none of it. And they used to own 30%. And this is over a 30-year period. It's declined. Insurance companies as well used to own 20%. They now own almost none of it. And the other lines here, there's quite a lot of noise, but it's a bit of a zero-sum game. So who's buying the market? It's being bought by overseas investors. And so now 53% of the market in 2022 was owned by overseas investors, non-UK investors. And actually, this is a bigger theme talked about by Dieter Helm, if any of you want to look at his work, who says actually, points out just how dependent the UK has become on overseas investment. And actually, in the whole discussion around water companies, we're surprised that they're all owned by overseas investors. It's because we've been depending on overseas investment to a very big degree for a long time. And that dependence just seems to be increasing. So again, pause for serious thought. This is the slide about the special dividend. This is looking at the amount we invested in qualifying qualifying investments versus the amount we've sold from qualifying investments. 2021 was a big year. There was a lot of cash and there were a lot of deals to be done. As I said, we were much better off having not done those investments. So I don't feel proud about 2021. It was, it was a crazy year and we didn't do well out of that. But what you can see happen after that is the disposals we've been making have matched or exceeded the amount we've been investing. And in 2022, you can see those hash bars, those are takeovers in the portfolio. So there's not investments we chose to sell, they were forced sales in a way. And so actually cash started rising in the portfolio and hasn't been diminishing. And in a way, that's why we ended up in a position where we had a very large amount of cash, more than 30% of the portfolio by value in cash. Our deployment rate was not barely quick enough to keep up with our disposals. And of course, more takeovers will come along. And so it just made sense to lower the cash level through a special dividend. Now, to talk about the portfolio, these are the top 10 holdings. And I always show these bubble graphs. And as you can see, these are vintages by year of investment. And you can see 2021 there, you hardly see it. So there's not much, there's a negligible amount of value really in the portfolio from that period. There are a couple of holdings we got there, hopefully we'll get a good return on them. And broadly you can see the pre-2016 investments. These are the ones before the rules changed. So whenever you make a VC investment, bear in mind the rules changed dramatically in 2016 and we were forced to invest in much earlier stage businesses at higher risk. The whole part of our repertoire as investors got taken away, so we can no longer do roll-up investments. And some of these big success stories in the portfolio keywords, for example, was a roll-up investment. But we have more than half of our investments now in this mature part of the portfolio, these keywords, learning technologies, AB Dynamics, GB Group, Craneware. These are mature businesses. And yes, they've declined in value over the last couple of years, but they're very good companies. I've got no anxieties about these businesses. The valuations, I'm pretty confident, will bounce back. Where they don't, they'll get taken over. And as I'm sure you've seen, there's a bid for keywords last month. It was very accretive to the NAV. And it's actually where it helps to pay a special dividend out because these holdings then become more important than when we're not carrying so much cash. And then, the real question, and the thing we're going to focus on really in this talk today is, well, what about the investments post-2017? Can we make good investments under the new rules? Can we make good enough investments? Can we get a return? And at moments when the market's very depressed, of course, there's a danger of judging that question wrongly because the AIM market it's a volatile market. It goes from feast like 2021 when everything's up here to absolute famine like beginning of 2024 when the market's totally depressed. And the gap between the two in these kind of companies is very extreme. And so we shouldn't kind of judge what's going to happen in the long run from the moment we're in. I won't dwell on this. This is the top 10 holdings. You can see it. But you can see, most of these, I think 8 of them are dividend-paying companies. They're quite large companies. Origo is the one anomaly. That's a post-2017 investment that's done well. I think David will talk about that later. Maxite's a post-2017 investment. It's a £350 million company, NASDAQ listed, still loss-making, but very well funded. And actually one of their non-executive directors made a big investment in it just last week. So, that's all, I think that's in a very good place. So top 10 holdings. We're going to divide up the portfolio by maturity profile. So as I've said, 45% here, what we call mature companies. Those are really all pre-2017 investments. But it's good to have that level of investment in these mature, small and mid-sized companies. They're profitable companies. Everything that's loss-making we put into the halfway category, where they've got halfway means more than 10 million in sales, but still loss-making. And then what we call early, it's any company with less than 10 million of sales. And typically, the kind of investments we get shown that are VC qualifying, the majority of them start with less than 10 million of sales. So that's how we're going to categorize things. So I think it's helpful to bear that in mind. And then I suppose this is really how the bubble chart looks when you analyze it by these mature, halfway and early. And we got some actually 2024 investments that we've only just invested in them, but they're already halfway. So actually we love those kind of companies when we can squeeze a qualifying investment in a company that's already further down the road. That's absolutely what we want to do. And then to look at it in a bit more detail, so this is just the 2017 onwards, and you can't see Maxite because I've moved the scale here, so the market cap only goes up to 150 million, Maxite's 350, so it's kind of off the picture. But this is just to show in much more detail what's going on. And you can see we've got quite a few companies here that are halfway businesses. The two companies that are going to come to present later are both in this halfway category, and we thought actually we should have two from this newer part of the portfolio this year, and they're really there to give you the idea, well, what have we got in the portfolio that's in this category, and how excited should we be about them? And I hope that you will feel really enthused about the companies that are in the portfolio when of the two which are coming really, I think, are well representative of the kinds of things we have in this part of the portfolio. And because I'm running out of time, I'm not going to dwell too much in all of these names. Please do ask questions about the ones we've got here. But there's a lot of, what I will say about them is these companies have been through a very strong refining process through the tough markets. The valuations are horribly beaten up. So when you get to this point, actually, they become really interesting. And because of the condition of the market, the new investments we've been able to make in 2024, we're making at prices which I haven't really seen since the great financial crisis for really small companies. And we're able to buy really significant stakes in companies for not very much money. It does mean we're not deploying very large amounts of money, but we're getting big chunks of these companies, and they've been around a long time, and they've really been through the mill, some of them. And generally what happens in these periods is they come out a lot stronger. So actually, we're pretty optimistic about this group of companies. Yes, it requires patience. These companies are still early and halfway. They have their fragility, and they won't all work out. But the ones that do work out from the valuations they're now at, we think we should see some really good returns start to appear from this part of the portfolio. And with that, I'm going to hand over to my colleague David to talk through some of the themes in the portfolio.
Thank you. Good afternoon, everybody. I'm going to look at the portfolio in a bit more detail. And I'm going to start with a thematic analysis of what we own currently. That's different from a sector analysis, but we think it's more illustrative of the themes that we are investing in and the sort of prospects for the companies that fit within those themes. And there's three here I'm going to cover. They account for 60% of the portfolio, so this is pretty much the core of the ideas that we have within the fund. The first one, digital technologies. Paul touched on it earlier. This has been a long-term thematic for us. It's a busy slide because this accounts for almost a third of the portfolio. And using the maturity analysis that Paul spoke about earlier, you can see we have representation right across the board, early, halfway, and mature. And the companies here are ones which have digital products, digital services, platform capabilities which cover a multitude of end markets. So this is a very diversified group. And if I just touch on some of the end markets, we cover healthcare with a company like Craneware, which I'll speak more about in a moment. It sits very well within the mature category. We have consumer-related businesses, Accesso and Keywords, Accesso in leisure ticketing, Keywords, as Paul's mentioned already, in outsourcing of video gaming services. We have training and talent management companies, North Quarters, which presented a year ago to you, a learning technology group as well in that space. Transportation companies, Cordell, which is involved in rail network monitoring, and SRT, which does marine surveillance. Security, Chorus and GB Group, involved in online security. Semiconductor manufacturing in Silica, a halfway company that presented a year ago to you. Financial services, PCI PAL and Equals, involved in secure payments. And microelectronics, strip tinning and solid state. So these are sort of examples of companies, all of which we feel have long-term growth drivers. And these markets offer scope for early stage companies to really penetrate, take market share because of the differentiated technology that they have. And it provides them then with a bit of a competitive edge to allow them to grow quickly. Moving on from digital technologies to healthcare. We presented this slide last year, and there hasn't been much change in the constituents within this theme. It's been a tricky area over the last 2 years. There was pretty much a pandemic bubble in healthcare companies. A lot of that 2021 hyperactivity in the market involved early stage healthcare companies, both IPOing and also raising secondary funding. And we went from a very health-focused environment to the other side of that, where risk appetite and funding has been really frozen. And so it's been a very difficult environment for these companies more recently. We, as I say, have the same names on this slide as last year, which shows that there's some durability within the holdings that we have, but we are still light on mature companies in this space, reflecting the difficulty of that breakthrough to real commercial scale. Diaceutics will be presenting later, which is one company that we feel will make that breakthrough. In terms of how we risk control in this space, because of its difficulty, we don't do things like drug development. We don't do early phase trialing. We're focused very much on companies that we think have got a speed to market, they can get to market, and they can scale commercially when they get there. But the early stage nature, the loss-making nature of these companies means that they do burn cash, and they do need to be financed on an ongoing basis. The sort of end markets we're looking at here in medical devices, which covers Polarian and Creo Medical and Intelligent Ultrasound. We're also involved in diagnostics, and Diaceutics is an example of that, and you'll hear more from them later, as I say. We're involved in clinical trial services, so not companies that are developing drugs, but companies that provide assistance to companies to do successful trialing and develop commercial products from that. So that's Ixico, and also in cell engineering, Maxite, company Paul's already mentioned, that has broken through into being quite a material market cap size. Third category I'm going to look at is environmental technologies. This has been, to be frank, another tough area. There's been an awful lot of over-promising and under-delivering in the environmental space in recent years. It's pretty clear that decarbonisation and energy transition is going to take a lot longer and cost a lot more than the headlines would suggest. Some companies are going to succeed, but an awful lot of companies are going to fail and not reach commercial scale. Again, we diversify across a broad range of end markets. In renewable energy, we have Windar in the early category, a more recent investment. Windar provides LiDAR, which is a laser guiding capability that's attached to wind turbines to improve their directional positioning and efficiency. We've got water and heating conservation with companies like Xeros, Eneraqua, Kinovo, and Water Intelligence. Water Intelligence is involved in leak detection, mainly in the US, but clearly there's a huge problem. What was the statistic we got told yesterday? 3 billion litres of water leaks from the UK water network every day. 3 billion litres. We're involved in electric vehicle, EV, and autonomous vehicle development with AB Dynamics, which does vehicle testing, and Origo, which Paul mentioned earlier. Origo's involved in developing autonomous airport vehicles, and I'll say a bit more about that in a moment. We're involved in biopesticides and plant-based ingredients, companies like Eden and Itaconix, and also in decarbonisation. An example of that is Velocity Composites, sitting in the halfway category. They are also presenting to you today, and again I'll say a bit more about them in a moment. So a broad spread of companies, end markets, and maturities. That's a really good diverse thematic. So how are these companies and these themes contributing or not to performance? Well, I'll begin with the positives. And here we have a spread of some of the more mature companies that were in that previous analysis. Craneware, Keywords, and Solid State all fit into that category. Craneware is a provider of hospital billing and revenue management software, almost entirely a US business. It floated in 2007 and is now a more than 800 million market cap company, so it's in the mature category. Post-pandemic, that was a really tough environment. Hospitals and pharmacy providers were cutting back on spending and non-essential spending. That has since recovered, and we're seeing a return to EPS upgrades, and Craneware has responded to that, has performed very well. And in fact, in the more near term, it's up 150% in 6 months in share price terms, which shows the sort of recovery you can get in some of these names. Keywords, Paul's mentioned already. I won't say an awful lot more, other than it floated at 50 million in 2013. We took part in the IPO. It's now 1.75 billion. It had a tough couple of years leading up to the bid in May. The market took the view that Keywords, as a provider of technical and creative services to video game publishers, would suffer seriously from AI, that a lot of what they do could be automated. And so the share price underperformed. But in May, the company was subject to a bid by the very large Swedish private equity group, EQT, who clearly isn't concerned about those sorts of issues. AI may well have an impact, but Keywords is a very large, robust business and will incorporate AI into its own operations to benefit from it. So the bid was at a 70% premium to the last share price, and we took a bit of money off the table. There's a put up or shut up, which means other bidders have to emerge at some point by 15th of June. So we've taken 3.5 million off the table, taken the holding down, but we still hold a material amount. I'm delighted to say that the Smaller Companies Fund, our Smaller Companies Fund, also appears on this slide, which is representative of what's been going on in the UK small and mid-cap space in the last 6 months. Our benchmark for that fund is up nearly 25% in 7 months. Pleased to say that the fund has outperformed. It's up 27%, but we are beginning now to see some traction in the UK small cap market. Diaceutics I will basically leave to the presentation in the interest of time. Solid State as a company it floated in 1996, but we didn't invest until 2013. We've made 6 times our original investment on that company. It is a distributor of microelectronic components, but also a designer and manufacturer of components, so they provide a full range to their customers. They position themselves in the mid-tier of the market, so they do what the larger distributors and manufacturers don't want to do. They won't bother getting out of bed for, but they also do the things that their smaller competitors are unable to do. So there's a thick, valuable mid-tier stream of market that they're supplying, and they've been a story of organic growth and lots of acquisitions along the way. So it's a very sustainable business. In terms of what hasn't worked, and there have been disappointments, it's dominated by 2 names really, Polarian and Saeta. Paul's already spoken about Saeta. Polarian is a healthcare company applying its medical imaging technology to pulmonary medicine, so lung conditions. It was the subject of a follow-on refinancing recently, up to $12 million fundraise, which was done at a penny, which was fairly punitive, which reflects the difficulties of some early stage companies raising money in this market. That raise mark to market at a penny is what effectively caused the impact to the portfolio. But the money they've raised gives it the potential to get its lung imaging platform fully launched, and the ability to recruit further sales resource to accelerate the sales growth going forward, and the possibility of investing in further new products to launch. We had been selling before the raise, but took the decision that we would reinvest some of what we'd realized, about 50% of what we'd realized, back into the company, because we think the fundraising should reboot its potential, hopefully. Frontier Developments has shown very strong rebound in its shares. Tough consumer market post the sort of supernormal conditions in the video gaming market. Lockdown encouraged a lot of activity, which just wasn't sustainable going forward. Frontier Developments has changed its strategy. It's going to focus on in-house products rather than third-party publishing of products. And so we think there's a recovery potential there. So Sander is an online women's fashion brand, doing very well in the online space. Again, changed strategy or augmented strategy by focusing on rolling out physical stores. The market took exception to that. They're reinvesting the cash they have in physical stores, which took the market by surprise. They're also ending promotional pricing, and so that might be a headwind to sales growth near term. So the market has reacted and the shares have underperformed, but again, we think it's a recoverable business model from here. And SRT Marine, which experience a lot of what we do experience in companies of this size. They win contracts, but the lead time in terms of turning that into revenues can get affected by clients' timetables, not the company's timetables. And two very large contracts, 180 million in total, have been delayed in Asia and the Middle East. And so that's impacted the share price, but the company is well funded. It did a non-qualifying fundraise in December. So we see recovery potential in these names. A couple of very quick slides for the record. Geographic distribution. We always like to emphasize that although we invest in AIM, yes, we do have companies in aggregate 40% with UK sales, but our successful companies are international companies as well. So we do have international revenues in the portfolio. This is the sector weighting slide, which we don't think is as illuminating as our theme slide, but it's no surprise that all forms of technology, IT, industrial tech, healthcare tech, and fintech are the major sectors within the portfolio, which reflects the themes that I've been discussing. Very quickly on deal flow, to put it in a historical context. Yes, there has been fewer deals to look at in recent years, but we haven't been inactive. If you look at the middle line here, number of deals in which we participated, the activity levels 22, 23, 24, we're still able to find investments in this environment. Our ticket sizes, as Paul indicated earlier, are lower given the fundraises that some of these more mature companies are doing, but we're certainly able to still find places to put money to work. And the interesting thing is that we're putting money now into companies where the valuations reflect what's gone wrong with AIM in the last few years and doesn't reflect the commercial prospects for the companies, many of whom have been around for several years and are on the cusp of commercial scale. So that valuation commercial potential combination is really attractive to us at this point. Finally, to finish very quickly, this slide, the names that are on this slide, this is investment activity in the second half of the last calendar year. It's all in the report and accounts up to January of this year. So Velocity Composites, again, presenting to us today. The detail on that, on these companies, is all in the report and accounts. And what we've been doing calendar year, well, it's a busy slide, and that's because we have been busy. A good combination of follow-on and new investments. The new investments aren't IPOs. The new investments are companies that are new to the portfolio, but there are companies that have been listed on AIM for a variety of maturities. If I just very quickly highlight a few things. Strip tinning, we followed on in a £500,000 convertible loan note investment. Strip tinning is an automotive engineering business. Its core business is supplying glazing components. Your car windscreen will be, in terms of the heating and other aspects of it, the heads-up displays are done by strip tinning. But the interesting thing is the new market it's been entering in recent years, which is the EV market, where they do battery cell contact systems, CCSs, which connect EV batteries to battery management systems, which are absolutely crucial to the function of electric vehicles. And what they're doing is they are replacing the very heavy traditional wiring harnesses that you get in internal combustion engines. Those are too heavy for electric vehicles. So these CCSs are very, very light printed circuit-based connectors. Subsequent to the follow-on investment, they've just announced a more than 40 million 5-year contract with a German OEM who is supplying a US manufacturer of autonomous vehicles. I can't name the name, but I'm sure you can guess who that is. It's a household name. So, there's a company winning, material business on the back of a fundraise, and that's what we're looking to do. We're looking to put money to work for the right reasons. It's companies raising working capital to fund their growth. Hopefully that gives you a sense of where the portfolio activity has been, and you get a sense of some of the conviction that we have about the newer positions that we have in the portfolio. And that really concludes the fund manager presentation. Open now to Q&A.
Yeah, so we have a little bit of time for a couple of questions if anybody has any. Do we have a microphone that will come around if...
Oh yes, you mentioned that you didn't invest in drug companies, but surely Arecor is developing insulins. It's one of your investments, is it not?
Yes, that is true. I was thinking that when Dave, that's our only one that is developing a drug, but it's a kind of reformulation rather than a brand.
Yes, it's not
a brand new. It's not a new drug, if you see what I mean. It's a reformulation of insulin.
It's improving the efficacy of existing drugs.
Yeah, but well spotted. Any? Yes, Olivia, we have a question at the front here.
Thank you. Notwithstanding your elegant descriptions of what's happened to the market in the last 2 or 3 years, which is consistent with a number of other companies, but I also own a number of other AIM-related BCTs and other companies, and I would say generally the Amati portfolio plunged more than most, and it's definitely been slower to recover than most. I think virtually all the companies I'm involved in have managed to make small profits this year and have pretty much recovered from where they were, whereas Amati still seems to have a long way to go to recover the sort of vavaroom you had sort of 5 years ago. Is there anything fundamental, or maybe this is part of your review, that reflects the fact that you seem to have a very slow recovery in the companies that have survived the downturn?
Yeah, I mean, I don't know which companies you're referring to. There aren't very many AIM VCTs, so the peer group is very small, and I don't think our performance is massively out of line with the overall peer group. But it's a very small peer group. I mean, I think the thing to bear in mind when you look at AIM VCTs in general is we have to invest at the very early stage end of the market, although we can carry our investments for a long period of time, so we end up with some mature companies. And in a way, the discrepancies are, how much have you got in mature companies? Some of them get taken over. You can get some quite big moves on the back of it. But I'd say probably all of us doing AIM VCT investing have had a difficult time with the newer companies over the past 2.5 years. And we've all been through, the position we're in will reflect other AIM VCTs as well. I don't think it'll be radically different. And there's also another difference in the degree to which investments are made in private companies. And obviously this is something we've talked a lot to the board about, and we're still considering, that whole dynamic of to what degree do we just focus on AIM, to what degree do we go into unquoted companies. That, it's a big discussion and one we're still considering really. But I think it's safe to say that this will remain an AIM VCT. It's just the question is at the edges, at the margins, what how much do we introduce of perhaps pre-IPO investments, or are there ways we can encourage the right kind of companies to come to the AIM market? And I'm very aware that those declining slides I was showing on AIM, it doesn't reflect the UK in general. There are some great businesses appearing in the UK, but they're not floating. And actually, this is a serious issue that is, I think, underestimated in terms of how important are public markets. I personally believe they're massively important, They're really important kind of, part of a modern democracy is you have a stock market. Actually, I saw Philip Hammond talking yesterday at a Peel Hunt conference, and he was saying he couldn't prove this point, but he kind of thought stock markets are important. I'd feel a lot more confident about that. These are the way that you and I can save. If you want to have everything being private, then the general public has no access to that really, and can't have access to it. But it's fine if you're from a business family and you've got connections and directors and people who are connected with private companies who'll give you those investment opportunities. But it's the public market that kind of democratizes the access to the best businesses in the country to invest in them, and actually puts our savings to work in a way that is really important and very productive. It does much more good than putting it in the bank. So, yeah, I mean, that's why I'm a bit worried. And those are the kind of discussions we've been having.
But it is a fair question. And I think if you look at the makeup of the pluses and minuses slide, AIM is always subject to swings and roundabouts. And so companies that do well generating about 100 basis points of contribution, companies doing badly generating about 100 points of negative contribution tend to balance out. We had two names that had a significant impact in the last year. One is Polarian and one is Saeta, and lessons learned from that.
Yeah.
Yes, you mentioned that since Amati was set up in about 2010, the directors have aimed at a dividend of around 5%. Obviously, in the last few years, interest rates have risen, so it's quite easy to get a 5% or higher return in the bank. In order to encourage new cash into VCTs, do you think that the board would need to increase their aim above a 5% return, particularly with declining share price?
Yeah, I mean, the 5% dividend is not really related to interest rates. And the way to think, it is a capital return. And I suppose we have to find a level where we think it's sustainable in the long run, and you can run this over 10 years. And in a good year, you're going to pay less than your gains. In a bad year, like we've had, you're still going to pay 5%. So you've got to be able to sustain this capital return kind of through thick and thin. And I think 5% just sort of felt like the right kind of number where that was a sustainable number. It's interesting that the whole industry seems to have converged on that point. I mean, the other point to make about it is there's obviously some sensitivity here from Treasury and VCT policy that investors in VCTs get a big tax relief on investment, and the policymakers don't want to see just that money handed back too quickly or too randomly. And so if you start to push your dividend levels too high, I think actually it would be counterproductive, because you'd also see a policy response to make that more difficult or impossible. So we have one at the back, and then we have another one at the front.
Paul, thank you.
Yeah.
I'd be interested, you mentioned Peel Hunt. I'd be interested on your view and take on some of their rather negative research notes on the death knell of the UK small cap market. It doesn't really help when incumbents such as they knock their own markets as much as anything else.
Well, that's interesting that you read it that way. I mean, the way I see what they're doing, I see it much more positive in that. I think they've been very good at actually trying to stimulate awareness of that there is a problem here at quite senior political levels. They've raised this as a discussion point to a level which hasn't really been there before. And I'm sure you'll know Charles Hall, who's their head of research, has been doing a series of podcasts which have been actually very, very interesting podcasts. There's one coming out tomorrow which is rather dodgy, which I'm featuring in. So I recorded it a week ago, and they're releasing it tomorrow. And I kind of go through quite a lot of discussion about how we see the issues of the AIM market and the kind of things we'd like to see to help it move forwards. But I see what they're doing as more positive than that, even though maybe it gets reported in quite a negative way. Their intention is very clearly to support the market and bring about some changes that are necessary.
I mean, it's worked to the degree that we are getting proper debate now. The next thing is what comes of that, what action is taken, but at least the talking is happening.
I think we have one more question at the front here, and somebody's been we've only got time for one more at this point, but very happy to carry on discussing with anybody in the break.
Some years ago, I came to a meeting and the company that became Equals turned up and gave a presentation. I just wondered if you could comment and explain just what is going on with them, because I keep reading about, well, are they going to be taken over? No, they're not going to be taken over. Are they putting themselves up for other people to come in? And it seems very uncertain. And I just wondered if you could explain what's happening and whether or not you took advantage of the spike in the share price. Okay?
Really interesting question. Thank you for that. I obviously know Equals very well, but I have no kind of privileged information about them in this. I literally have no more knowledge about whether this takeover is going to happen or not than anybody else. And so I don't really know what's going on from that point of view. I mean, broadly, the company has become profitable. It's really improved as a business. It's had quite a patchy life on the market. It made some good steps, it had some bad steps and good steps and bad steps. It's finally got to quite a good place. Will it be taken over? I really don't know. I mean, we're not rushing to sell it because I think it's become quite a good business, and we'll find a reasonable way forwards, and possibly being taken over would be the right thing for them. But in the short term, I don't know, but it's a very good question. Thanks for asking it. I think we're going to take a break now, and we start again it's a 5-minute break, and then we're going to have the first company presentation. So, yeah, thank you.